Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 20 minutes, we'll talk about 2 or 3 key aspects of mutual funds. Some of you have written to us that this is a good time to do a systematic transfer plan. A lot of you might not even be knowing the benefits of an STP. So we'll talk about what are STPs and whether there's a good time to deploy money through a systematic transfer plan. There is a lot of move towards passive investing, and so many people talk about whether a large cap fund is even worth it, or should they simply take a Nifty ETF, or are there other options available? So we'll find a comparative conversation with our two guests on that very subject. And of course, with the Reserve Bank of India policy less than a couple of days away, we'll try and preempt what the RBI is doing and the impact thereof on the debt side of the portfolios, and ask our guests what would they do if they were in your shoes. To talk about that, Rajiv Shastri of NJMC and Tarun Birani of TBNG. Gentlemen, both of you, thanks so much for joining in. Lovely having you. Rajiv, this is the first time that we're talking to you. Let me start with you. Do you guys recommend investing via a systematic transfer plan method, especially in a scenario like this, wherein the odds of the markets correcting versus the market stabilizing are almost equal? You would argue they always are, but this time around maybe even more so.
There's a systematic transfer plans and before I begin, thank you so much for having me. And, it's always a pleasure to be here. Systematic transfer plans, I think, are a wonderful way of investing if you're unsure about market conditions, if you're unsure in any way or shape or form about what the markets are going to look like in, through possibly a near-term horizon. Systematic transfer plans don't actually, if you were to look at it from a very long-term point of view, they may or may not help. Right, but what they do address is, short-term pain. If one has a lump sum, one has a large amount of money to invest per se, and if someone tries, invest it all at once, and if the market goes down, there's a lot of short-term pain that it causes. Right. Long-term, I'm fairly sure that if someone invests, either lump sum or systematic transfer or systematic investment plan, SIPs or whatever, and if they remain invested for 10, 12, 15 years, I think they will end up making a reasonable amount of money regardless of how they've invested. But the short-term pain, addressing the short-term pain, I think is a very, very important part, and STPs help you do that. And especially in times of elevated market confusion, elevated valuations, where there's uncertainty with regard to what we about where the markets are going to be headed in a shorter period of time, I think that they're a very, very good way to enter them.
Tarun, you want to weigh in on this? First, just maybe a small explainer of what are STPs, and therefore, do you concur with what Rajiv is saying? In the current market scenario, do you reckon STPs are a good way to deploy a pot of cash?
Absolutely. I think Rajiv summed it well, but just to give you a background, STP is a method in which investor transferred a defined amount of money from the source scheme to the target scheme, right? So we all know, right? Lump sum investing is fought with uncertainty in the current environment. Nobody's sure how the geopolitical risk will play out. There are so many factors, India decoupling, this, that. So I know we have so many news data rooms right now. So in this environment, if you ask me, deployment is critical. Your deployment cannot go at one stroke. It has to be staggered. And what better than systematic transfer plan? Maybe I want to add with a couple of more efficient STP strategies. There are value STPs available. There are some booster STPs available in the market. So these strategies can really help you invest more when the valuations are much more reasonable. So there are plans available wherein, let's say, you can define a valuation matrix based on price to earning, price to book value, market cap to GDP. There are various parameters based on which you can invest more when there is more blood in the street, right? 3x, 2x more when the blood in the street is more. Compared to currently, maybe you would go lesser when you feel you are in neutral or outperformance range. So I think those are also some of the strategies. Maybe somebody who want to deploy a large sum of money, the deployment can be done much more sharply.
Okay, so Tarun, there are some new terms out here as well. In the current scenario, the current landscape, whether it's a value STP or a booster STP, what have you, what is it that you recommend, and what is that particular kind of STP? Then we'll of course ask Rajiv about whether there are such offerings within their stable as well or no. But first to you, what is, if you believe a value STP is a good one, what is a value STP? and why is it good currently?
Yeah, so valuation driven strategies are strategies which helps you stagger your money. So there are two kinds of STP. One is a simple STP wherein, let's say if you have 10 lakhs to invest, what you will do is 1 lakh rupees every month for 10 months on a defined date, first of every month, or a weekly basis you can do it. A valuation driven strategy will define that maybe 1 lakh is your monthly limit. But what you will do is right now, from a valuation point of view, you feel that markets are overvalued. Maybe you will only go 10,000, 20,000. The index will decide. And maybe third month, like a March 20 kind of scenario, when the markets were down 30%, instead of 1 lakh, you can go 3 lakh in that month. I think a normal STP, you would consume all the money in 10 months. So maybe a 13th month, if there is a big fall in the market, you don't have money to invest. Maybe a valuation driven strategy can help you get allocation in those blood in the market kind of period. And behaviorally, I think we as investors don't invest at that point of time.
Yeah, sure.
This could be a beautiful way to manage your behavior and let the algo runs it. The valuation matrix runs it.
And would most MF houses offer such options, Tarun?
I don't think many have that, but I think valuation strategies are available with many asset managers. You have these balance advantage funds are again a quasi way to increase and reduce the equity portion in the portfolio. But in a pure equity way, there are some fund managers who are offering this.
Rajiv, what are there some products which are of this nature, if not value, then some other way? And what would you believe would be a good way to deploy this STP money? A plain vanilla STP is good enough. Do you guys give some options at NJMC as well?
Okay, so I'll divide the answer into two parts. Number one is, the first part is a normal STP versus a value STP, as Tarun, explained. We have a balanced advantage fund, which automatically allocates money between debt and equity depending on market conditions, and it happens taking into account a lot of parameters. So for investors who are actually looking to kind of time the market but not really time the market, this is a good alternative to have it, where based on valuation the money keeps on moving in and out of equity in a very tax efficient manner. In volatile market conditions, let's say, it's very difficult for people to take money out of the market without actually booking a profit and, incurring a tax event. So balanced advantage funds offer all of that happening within the scheme itself. So there's no cost to the investor. There's no tax cost to the investor. So that's a big advantage that we have. The other part of it is, value STPs. There are value STPs that are on offer in the industry, I believe, but they would apply largely to 100% equity products. So if you're keen on investing in a 100% equity product, right, and remaining invested for the long term in that particular 100% equity product, then a value STP would be a good way to do it. But in general, we see a lot more people gravitating towards balance advantage funds, balance fund, because they kind of end up balancing the risk without creating too many tax events for the investor. So that's what we've been observing.
Okay, great. Thanks for that. Now, the second topic, right, which is, viewers, I hope you got some gist of how to use a systematic transfer plan. There are a couple of options out there that Tarun spoke about. And of course, Rajiv spoke about how you could, maybe do an STP in a product like a balanced advantage fund, who knows, or maybe do a lump sum there, and then the fund manager will choose when is it that he or she wants to rebalance between equity and debt, and maybe leave the decision to the expert. So that's an option to consider. Now, a lot of you have written to us, have commented on the shows about how their large cap fund returns haven't been great. The SPIVA scorecard lays out how passive strategies have beaten or almost been parallel to actively manage large cap funds for a really long time in a lot of cases as well. So our question to both our guests today, and this I'll start with you, Tarun. A active large cap fund versus a Nifty ETF versus a passive index fund, right? What should an investor choose and why?
So to start with, Nifty ETF as well as passive index fund, according to me, there's not much difference in the underlying asset. ETF is just more of a way to buy index directly through a stock exchange, and index fund basically you buy through a mutual fund. So based on the investor convenience, one can pick and choose. Definitely ETFs would be much cheaper compared to an index fund. But from a convenience point of view, index fund can offer much more convenience. So investor can decide whatever is the best method for them to pick up. Now let's talk about the passive fund versus the active large cap fund debate. And I think we are more and more seeing that keeping the best trend in India also, we are observing almost 70%, and based on the SPIVA study you are talking about, the 10-year SPIVA study on the rolling returns shows that 67% of the funds have underperformed the large cap funds, right? The active large cap funds have underperformed the index, right? So that's a large number, and this again shows that the survivorship rate has been low for these funds, right, over a long period of time. So keeping that in mind, and I think markets are becoming more and more efficient. SEBI is working on, I think there is a recategorization which SEBI brought in. The fund managers have to work under a framework which is very common for all of them. So under these circumstances, I think to find a extreme value in this environment, I feel is extremely difficult. And I don't think I want to bet my money on chances. I want more visibility on a reasonable basis over a long period of time, where my behavior is driven more out of a passive way, wherein behaviorally I am more correct, right? In terms of, let's say, DLF 10 years back was part of my portfolio in Nifty, right? From a fund manager perspective, I will continue to own, because if there is a 50% fall, the fund manager will continue to own that stock. But I think the index will quickly take that away from the index, right? Because I think there is a churning process which keeps happening in the index. So from that point of view, behavioral point of view, index is a very beautiful way. And what better than betting on a Nifty, which gives you access to top 50 companies in the country. So I feel time has come wherein at least the large cap allocation can start moving into index funds.
Rajiv, you guys may have a large cap fund. Excuse me for not knowing that, but with the presumption that you do, what is the argument for somebody to come to a large cap fund versus a passive index strategy?
Okay, so again, a couple of things. We do not have a large cap fund, but to my mind, this debate between large cap funds and passive strategies, I think is at root, not a debate between active and passive. It's a debate between large cap active and passive, right?
Sure.
The true opportunity for a fund manager to generate excess return lies outside the large cap space, because let's be clear. The large cap space is the top 100 stocks as been defined by SEBI. If 80% of your investment have to be in these over researched, over participated 100 stocks, then there's very little alpha that you're going to get out of it. So whatever a fund manager has to add has to be outside the large cap space, and there you see a lot of fund managers. So from a general mutual fund point of view, a flexi cap fund would work best. That is probably the best interpretation of a fund manager's vision of generating, of how he would manage money, he or she would manage money, than anything else. Now coming to us, we are rule-based active investors. We invest based on factor investing, and our approach to investing is completely based on data and past track record of stocks. So we are straddling the space between discretionary active and passive, in the sense that we create our own rules. We don't replicate somebody else's rules like an index fund. We create our own set of rules which we believe show the potential of adding alpha, and something which has proved to add alpha over a long period of time. These factors are very basic ideas about investing, basic themes of investing. So you have value, you have momentum, you have low volatility, quality. So you try and select companies based on the already published data which reflect these these characteristics, and include them in a portfolio, and try to create whatever alpha that you can from it. It's worked very well in developed markets. As fund managers there also, discretionary active managers there also have been struggling for a long period of time. Primarily because the factor investing part of it, the math part of it, was explaining a lot more of the return that they were generating.
Sure.
Right? As time passed. So, a lot more of the return that they were generating was explained by math, and the space for perceived expertise shrank quite dramatically over a period of time. So there's been a large movement of money, funds from, discretionary active funds to, rule-based active funds, which are either you can call them quant funds or whatever you want to call them. But there's a large amount of money that has moved here. Now, when it comes to active versus passive, right? Now that's a much larger discussion. And active versus passive is not just about active large cap versus passive. It's whether you should manage money actively or should you just replicate an index.
Yeah, but Rajiv, my point is, I agree. But for the purpose of this show, our conversation was bent towards the large cap space simply because a bunch of people are questioning the return efficacy that large cap funds have shown vis-a-vis what passive large cap funds have shown, and which is why the debate was narrowed. And that's why this, at least for this show, that was the argument, that should people choose that versus the other.
So like I said, Tarun pointed out again, the fact that SEBI has come up with very, very strict norms that govern the manner in which a fund manager can actually deploy money, right? Yeah. The space for outperformance has kind of disappeared because if 80% of your money has to be in those 100 stocks only, right? Then the space for outperformance has kind of disappeared, and that is one of the biggest cause of of the phenomena that we're seeing right now.
Got it. Tarun, just one follow-up. There is no taxation differential between a Nifty ETF versus a passively managed fund, right? The taxation for both would be similar.
That's correct. They both are under the equity structure. So
okay, great. Okay, so viewers, again, a near consensus. A lot of you write, maybe a lot of you don't take action. Do consult your financial advisor. Maybe the financial advisor herself or himself will tell you that if you have a larger proportion of actively managed large cap funds which are not outperforming, then maybe she or he, if she or he is an efficient advisor, would give you the right advice to maybe shift some of your portfolio allocation from those into either passive schemes or flexi cap schemes, as the case may be. But I hope this answers the questions that some of you, in fact, a lot of you have put out in the last, couple of months to us on this topic. Okay, the last conversation point is trying to preempt a little bit of what the Reserve Bank of India would do. I'm giving you a hypothesis. Rajiv, I'll start with you this one. I'm giving you a hypothesis that the Reserve Bank hikes by 50 basis points, let's say. And if you're talking about this at Friday 4 p.m. instead of Wednesday 4 p.m., and you know that the Reserve Bank has hiked by 50 basis points, and the Reserve Bank is not dovish, even if it's not hawkish, what changes would you make to your fixed income mutual fund investments?
Okay. So the choice of duration, now we're talking only duration out here, we're not talking about credit risk at all because we're only talking about interest rate movements, right? So the choice of duration depends largely on the investor's risk appetite. So I'll break it up in three parts. Yes. For a risk averse investor, okay, someone who is very averse to risk, I think they should continue staying at the shorter end of the curve, because what will happen is if rates are high, then they'll get a higher rate of return immediately as overnight rates go up, and they would be protected from all fluctuations, all of that. But if you're investing for a really long term, then there's an opportunity cost to that. You might not be able to beat inflation. So if you try to negate all the risk in your portfolio, you end up negating most of the return as well. Right? So that's one part of it for the risk averse investor. For the risk aware investor, someone who is pretty much tuned to the kind of risk that they want to take, invest with your time horizon. So if you're investing for 3 years, roughly by a 3-year duration, so that you're not carrying any basis risk between the asset that you want and the liability that you have created in your mind for potential expenditure, right?
So you mean to say choose funds which are maturing according to
around the time you need money. Okay. Yeah, around the time you need money. So if you're planning for a car 3 years down the line, then choose a 3-year kind of product and stick with that. For the risk-seeking investor, okay, I think this if the RBI were to hike rates by another 50 basis points, I think we would be at if not at the peak, but at least close to the peak of this cycle. And I think you should go as far long as as your risk appetite allows. And I would, and take as much duration risk as you can take, because if it is, maybe a 2 or 3 year time horizon, I think that would end up paying off fairly well. over a longer period of time. So just into three parts, depending on the risk appetite.
Thank you. Thanks for putting it out so lucidly, Rajiv. Tarun, how would you respond to the same question?
So just like equity markets, Neeraj, I feel the debt markets have also more or less priced in, and these are leading indicators. So more often than not, I think the expected rate hikes have been already priced in the yields what we are seeing right now. So market is very efficient and they get this data point very quickly. But if I feel the major shock can come if there is a inflation data coming wrong, or again, the geopolitically, I think there are a lot of developments which are happening right now. If you look at US, there is an inverted yield curve which is playing out, which is clearly telling you that the short-term rates are higher than the long-term rates, right? So, which is like a clear signal of a recession which is growing in US right now and across the globe right now. So, these are very, very important developments for a long-term debt investors. But I feel these are very interesting times for anybody who want to build a debt portfolio. A nice way would be to build a laddering approach wherein define your requirements and goals. So let's say if there is a long-term retiree who is looking at building an annuity income, these are very interesting times for building up. There are funds available which are like 15 years roll down maturity funds available, which are giving you a 7.5% kind of returns with indexation. These are very efficient returns. For somebody to build a portfolio like this, yes, in next 6 months you could see further volatility, but I feel it would be nice to start averaging it out. And if you want to build a long-term debt portfolio, you can start doing STPs from liquid funds to long-term duration funds. But I think 5-year space is something which I like right now, where the yields continues to be very attractive, and maybe rundown maturity 5-year kind of funds are looking very, very attractive, and one can start building up there where you have a 7% post-tax kind of return possibilities emerging right now.
Okay, well, I hope this helps people in order to try and take some changes. If indeed the Reserve Bank of India were to make moves, rest assured viewers, the next Wednesday, we will actually discuss this impact in greater detail as well, with a full focus on the show on the fixed income side. But for today's show, first, a thanks to both Tarun, Birani and Rajiv Shastri for being with us and explaining us so wonderfully some key concepts. Really appreciate your time, gentlemen.
Thank you so much. Pleasure being here.
Pleasure was entirely ours. And viewers, thanks for tuning into this leg of the Mutual Fund Show.